Daniel.
And I'm Mira.
If you look at average investor sentiment today, Wednesday, August 5th, 2026, you'd probably diagnose a severe case of whiplash.
Oh, yeah. Whiplash mixed with a very healthy dose of mounting anxiety, honestly.
Seriously, it was a complete tale of two markets today. I mean, we came into the morning with this incredible early session equity rally.
Yeah.
Tech earnings were looking untouchable. There was all this hope for diplomacy.
And then the afternoon hit.
And that afternoon was just a harsh reality check. Just to give you the snapshot of the magnitude here. S&P 500 futures, they came out swinging, right? Flirting with an intraday high of 7,820.25.
Yeah.
But by the close, they plunged. I mean, completely erased the gains to settle down at 7,759.75. And the Nasdaq 100 did the exact same thing.
Right. It pushed past a massive $30,074 zero peak, only to aggressively reverse and close down at 29,595.75.
The only real celebration today, if you could call it that, was happening in safe haven assets.
Yeah, because when growth stocks are plunging like that, capital has to go somewhere. And today, that somewhere was gold.
It really was.
It staged a spectacular surge, blowing right past the $4,300 mark to settle at $4,304.30.
Which, tells you exactly how much fear is suddenly pricing back into the market. So for today's deep dive, we are going to unpack exactly what happened.
Right.
We'll trace the plumbing of this sell-off, starting with the overnight geopolitical and central bank pressures that quietly set the table for this volatility. Then we'll look at the domestic stagflationary data that basically crashed the morning equity rally. We'll break down the major tech leadership shakeups, reshaping the AI narrative, and finish up with our live paper trading segment.
And just a quick reminder before we jump in, everything we discuss in this deep dive is for market context and discussion only. It is not personal investment advice or an investment recommendation.
Let's open session one. What exactly set the stage before the U.S. session kicked off?
Well, to find that out, we have to look at what was happening before New York even woke up, because there were already massive cracks forming in the foundation, starting over in Japan.
Right, the Bank of Japan minutes.
Exactly. Late Tuesday, around 7:51 p.m. Eastern Time, the BOJ released their June meeting minutes. And, for a long time, the BOJ has been incredibly dovish.
Almost famously so.
Right. But these minutes revealed a remarkably strong hawkish consensus to keep raising interest rates. We actually had members explicitly proposing rate hikes about once every few months in order to reach a neutral level promptly.
So let's break this down for the listener, because, when you hear Bank of Japan meeting minutes, it's really tempting to just hit fast forward. It sounds like background noise.
It does, yeah.
But we have to talk about the zero rate carry trade as a global liquidity vacuum. I mean, for years, this has been the invisible plumbing of the stock market, right?
Yeah.
Is the market underestimating how quickly this capital repatriation could drain global liquidity and cap risk assets?
I think they absolutely are. I mean, the zero rate carry trade is essentially a financial glitch that massive funds have exploited for years. You borrow Japanese yen at basically 0% interest.
Free money, basically.
Exactly. You take that free money, convert it to US dollars, and use it to buy high-yielding assets, specifically US tech stocks. As long as Japanese rates stay at zero, you pocket the massive difference in yield.
But when the Bank of Japan suddenly commits to hiking rates every few months, the cost of that borrowed yen goes up.
Right. The yen strengthens against the dollar.
So suddenly the principal on that massive loan is growing. Those large funds face margin calls, and they're forced to aggressively sell their U.S. tech winners and repatriate that capital back to Japan just to cover their loans.
Which acts as a mechanical drain on global liquidity. And what these minutes showed is that Japanese policymakers are highly focused on upside inflation risks. They are not backing down.
Okay, so we have a massive liquidity vacuum starting on one side of the globe. But on the other side, we had a literal tug of war between diplomacy and ballistic missiles overnight, right?
Yeah, it was a very messy picture in the Middle East. On the diplomatic front, we had this carryover narrative from the prior session regarding negotiations to reopen the Strait of Hormuz.
Right.
Overnight, Donald Trump reported highly productive talks, and by Wednesday morning, it looked like Iran and Oman had actually finalized the geographic characteristics of a transit route, to bypass the blockade.
But wait, if the diplomatic back channels were actually making progress, why did the market completely ignore this Oman transit route?
Well, because a theoretical transit route doesn't ensure a cargo ship.
Ah, right. Good point.
Iranian officials firmly caution that this reopening remains entirely contingent on the U.S. returning to the Islamabad Memorandum of Understanding. So it's a bargaining chip, not an active sea lane.
And while the diplomats were drawing lines on a map, the physical reality on the ground escalated aggressively.
It did. At 3:03 a.m. Eastern Time, Yemeni Houthi rebels launched a ballistic missile at the Saudi-owned oil tanker Daisy, right in the Gulf of Aden.
Wow.
Yeah, and they officially declared a siege-for-siege mobilization, which explicitly threatens routes that were previously considered completely safe.
Which is why the market largely ignored the diplomatic optimism. But, rather than treating this as some unpredictable disaster, this really looks like geopolitical escalation as game theory brinkmanship.
Oh, 100%. The Houthis are applying calculated physical pressure to maximize diplomatic leverage.
Right.
But for investors, the issue isn't really the politics. It's the economic translation of that brinkmanship.
Because a missile in the Gulf of Aden acts directly as an oil shock, functioning as a multi-channel corporate margin tax.
Exactly.
When shipping routes divert, freight costs spike, energy goes up, it keeps input prices structurally elevated across the entire global economy.
And that hits margins everywhere.
So we've got global liquidity draining back to Japan and geopolitical margin pressure setting this incredibly fragile baseline overseas. We're going to take a short break. When we come back, we'll see how these overnight vulnerabilities collided with a harsh domestic reality check in Session 2.
Welcome back. Let's move to Session 2. What moved markets during U.S. trading hours?
Well, this external pressure collided with a massive domestic wall Wednesday morning.
Yeah.
A real double whammy of macro data.
Yeah, it started early. At 8:15 a.m. Eastern Time, the ADP private payrolls report flashed a major warning. The market was expecting around 65,000 jobs to be added.
Which is already pretty soft.
Right, but the report came in at a meager 44,000 jobs. That is a huge drop from the 95,000 we saw back in June.
So the labor market is objectively freezing up.
It is.
And theoretically, a 44,000 jobs print should bring bond yields down, right? Since investors would bet on the Fed cutting rates to save the economy. But instead, we got a massive supply shock in the bond market just 15 minutes later.
We did. At 8:30 a.m. Eastern, the U.S. Treasury announced a massive $125 billion quarterly refunding across 3-year, 10-year, and 30-year securities.
Wow.
Yeah, flooding the market with duration supply. And when the government does that, they act like a giant sponge, just soaking up available capital.
Yeah.
That puts intense upward pressure on yields.
Okay, so the labor market is cooling, the government is issuing a mountain of debt, and then at 10 a.m. Eastern Time, the fatal blow to the equity rally lands.
Yeah.
The ISM Services PMI report.
Right. The headline number was 54.1, which technically means the service sector is expanding.
Sure.
But the internal components were terrifying. The prices paid component, which measures the cost of inputs for service businesses, surged unexpectedly to a highly worrisome 70.3.
That's a massive jump.
Huge. Meanwhile, the employment index within that same report fell to 47.4.
And for anyone wondering why a 70.3 prices paid print caused the market to roll over, this is the textbook definition of a stagflationary shock. You have sticky, accelerating service sector inflation paired directly with a rapid slowdown in hiring. And service inflation is wage-driven. It's incredibly hard to eradicate.
And when inflation spikes while employment drops, it induces central bank paralysis, which brings us perfectly to the coordinated Fed hawkishness we saw today.
They really brought a hurricane to the equity parade.
They really did. We heard from Federal Reserve Governors Schmid, Kashkari, and Cook. It was a coordinated barrage. Governor Schmid explicitly called out that AI investment is actively fueling inflationary pressures.
Wow, specifically calling out AI.
Yes, and he stated flatly that current policy is not tight. Governor Kashkari chimed in saying it is time to slowly move interest rates up.
Up, not down.
Exactly. And Governor Cook warned that the Fed has very limited room to delay hikes if this disinflation stalling continues.
The market impact was just brutal. I mean, the early S&P 500 rally completely collapsed. It fell from 7,791 at 9:45 a.m. Eastern down to 7,754 by 11 a.m.
Just a straight drop.
Because we have to remember, risk-free yields act as gravity-compressing asset multiples. When the Fed threatens to hike rates, they are turning up the gravity dial. Suddenly, the valuations of these high-growth tech stocks just way too much.
Exactly. The multiples have to compress.
But I had to challenge this a bit. Are markets overreacting to Fed jawboning here? I mean, is this coordinated hawkishness actually just a bluff?
A bluff.
Yeah, because we always talk about the bad news as a Fed cut chicken game. History tells us that a freezing labor market, like we saw with the ADP miss, usually forces the Fed's hand, regardless of their rhetoric. Are they just trying to talk the market down?
It's a fair question, but I don't think they're blushing. When you have a 70.3 ISM prices paid print, inflation expectations risk becoming unanchored. The Fed has to prioritize fighting inflation over growth right now.
So that lethal combination of surging service inflation and hawkish Fed threads acted as a gravitational pull on all the morning's optimism. We're going to take one more short break. After the break, we'll pivot from the macro environment to the specific companies driving the tape in Session 3.
We're back. Time for Session 3. What were the major corporate events today, and what should you watch for next?
Well, beneath all this macro turmoil, the tech giants were making massive waves of their own. Let's start with AMD, because this was really the carryover from Tuesday, August 4th, post-close.
Right. AMD reported after Tuesday's close, but the ripples were the primary driver of the early Wednesday equity momentum.
It was the whole reason we were up in the morning.
Exactly. CEO Lisa Su provided a blockbuster forecast projecting that 2027 data center revenue will more than double year over year.
She was teasing the new MI500 GPU and the Verano CPU.
Yep, and forecasting that they will absolutely crush their long-term $20 earnings per share target.
Which provides fundamental armor against these broader tech valuation fears, right? Because the AI infrastructure as a physical power and metals bottleneck is real, but AMD is proving they can monetize through it.
It did provide armor, for a few hours at least, but then the narrative became much more complicated. At 2:06 p.m. Eastern Time on Wednesday, Microsoft dropped some very revealing financial disclosures. Oh, the OpenAI numbers.
Yes. It showed that OpenAI generated a massive $24.1 billion in revenue for fiscal year 2026.
That is a staggering number. It means OpenAI accounts for roughly 70% of Microsoft's total AI sales.
70%. That is a massive dependency.
And this ties directly into the third major event today. Right around 12 p.m. Eastern Time, we saw a massive leadership shakeup at Google DeepMind. Demis Hassabis is stepping down as Google DeepMind CEO to become chair and Alphabet chief scientist.
Right. And at the exact same time, Jeff Dean is leaving to found the AI startup Discovery Loop, which Google is heavily investing in.
Okay, let's connect these dots. You have Microsoft's massive 70% OpenAI dependency, paired with Google losing the literal architects of its models. Does this represent just a natural maturation of the AI space, or does this highlight how AI CapEx is just a self-referential valuation loop?
It really highlights the vulnerability. These hyperscalers are suddenly looking incredibly exposed to key man execution risks. If you lose the talent or if your partner falters, the whole loop is threatened. Well, folks, that's the closing bell on a day where the Federal Reserve didn't just rain on our equity parade, they brought a coordinated hawkish hurricane. We started the morning flying high on AMD's blockbusting outlook, only for the ISM Services report to crash the party with a spicy 70.3 inflation reading.
Yeah, quite the turnaround.
If your stock portfolio is currently looking a little bruised, just tell your spouse that you're strategically transitioning your assets. Much like Demis Hassabis transitioning over at DeepMind.
I'm sure that'll work perfectly.
The silver lining is that if you had a safe haven stash of gold, you're currently celebrating a spectacular run all the way past $4,300. If not, we can always hope Anthropic's new in-house chip team can build us an AI model that actually spins straw into gold before tomorrow's jobless claims.
We might need it. Speaking of tomorrow, Thursday, August 6th, here is what to watch next. At 8:30 a.m. Eastern Time, we get the U.S. weekly initial and continuing jobless claims.
We also get preliminary Q2 non-farm productivity and unit labor costs at that same 8:30 a.m. slot, which is going to be absolutely critical after today's hot ISM prices print.
Definitely. Then at 10 a.m. Eastern, we have June wholesale inventories, followed by the EIA weekly natural gas storage data at 10:30 a.m.
And overnight into Thursday, keep an eye on any ongoing U.S., Iran, and Oman Hormuz transit headlines, along with those Houthi and Red Sea shipping tail risks we talked about.